Schedule 1A, the new enhanced deduction for seniors. This is part of the One Big Beautiful Bill Act, the Section 5 of that form for Schedule 1A. This is a new schedule for the tax return for the 2025 tax year, and it's a temporary deduction, but it's all based on modified AGI. So some individuals are not going to qualify for that, even though they otherwise are old enough. So we'll talk about modified AGI and how we get that calculation. For most taxpayers, it's going to be their adjusted gross income. However, there are a couple of add backs. If you have foreign earned income, U.S. taxation of American Samoa residents, or exclusion for bona fide residents of Puerto Rico, they have an add back to get to modified AGI. Most taxpayers don't fall into that category, so for most, it will be their adjusted gross income. That calculation is done at the very top of page 1 of the Schedule 1A. And basically, when you get to line 3, you're going to use that throughout the tax return on all sections. This is the last section on page 2, the enhanced deduction for seniors. And on line 31, that's where that line 3 amount comes in, your modified adjusted gross income. Now, this deduction is a maximum of $6,000, but because of the phase out for high income taxpayers, it could be less. And we'll go through the math and kind of show you a couple of examples just on how we do that reduction. This is a temporary deduction scheduled to sunset in 2028. We'll see if they have an extender bill to push that down the road. Now, the One Big Beautiful Bill Act did not make any changes to the taxation of Social Security benefit as far as the calculation of someone's provisional income. That's been around for quite some time. In fact, this provision, it doesn't matter if you take Social Security or not. It's something that's age-based. It has nothing to do with whether someone's collecting Social Security payments. So let's talk about provisional income and where that came in. At its onset, Social Security was never supposed to be subject to income tax, but that changed. I believe it was 1984. The provisional income calculation came in where they take your adjusted gross income, have a couple of add backs here. Your non-taxable interest is added back in, and 50% of your Social Security benefits that you receive are added back into this provisional income calculation. Then we take a look at the thresholds. If you're below the threshold for a married couple, if you're below $32,000 when you do that math to get to the provisional income, it's not subject to income tax. However, if you're above that threshold, up to 50% of your Social Security benefits subject to the tax for the tax return itself. Now, about 10 years after that, they came in with a second tier where up to 85%. So for a married couple, if your provisional income is over $44,000, it's up to 85% is subject to tax. The problem with this calculation, most things in the tax world are impacted for inflation. This never was. These are numbers that have been in place since they started this whole program on provisional income and taxing Social Security benefits. That's one area that I believe they've missed the mark over the years. Now, this new senior deduction does not reduce AGI. Remember, AGI is part of your calculation. This reduces taxable income on the tax return. In fact, all deductions from Schedule 1A come in after you do this calculation, after you take the standard deduction, or perhaps you itemize. On line 13B is where the Schedule 1A deduction comes in on the tax return. So that's page 2 of the 1040. Common misconception. You hear a lot of people talking about this in the news, no tax on Social Security. How can the news be wrong when they tell me no means no? Well, to add to the misconception, an email was sent out by the Social Security Administration right after the bill was signed. Basically, it said that this provision eliminates federal income taxes on Social Security benefits, and that's where most people stop. But the last part of that email says for most beneficiaries. That's the key. You could have some high income seniors that are still going to have their benefits subject to tax, and they're not going to get the new senior deduction. So be prepared when you take a look at the numbers and the phase out on whether this applies in your particular client situation. Qualified individuals. A taxpayer and their spouse have to attain age 65 before the close of the year. That's it. That's the first hurdle. Are they 65? So I said you didn't have to collect Social Security to be able to get this. If I'm waiting to take my Social Security at age 70, where I can max out the benefit that I'm going to receive, but I'm 66 years old, I'll get this deduction because I'm 65, provided my income's below the threshold. On the other side of that coin, I could be 64 and taking retirement early and taking Social Security benefits at age 64, and I could be subject to taxation because of my provisional income calculation. I will not get this deduction because I'm not age 65. So this is an age-based calculation. Think of it this way. It's almost like an enhanced standard deduction if you're eligible for that. But this one is subject to a phase out based on your income, where your normal standard deduction is not. So qualified individuals, a married couple can take $12,000 if they're both age 65 and below the threshold. So this will eliminate taxation, whatever the tax is on Social Security benefits for some taxpayers, but certainly not for all. The deduction itself, we talk about your income being too high. We calculate the modified AGI. If you're single, head of household, married filing separate, 75,000, whereas that reduction begins. It's double that at 150,000 for married filing joint. So that's a 6% reduction when your modified AGI exceeds those numbers. So here's an example. We have a single taxpayer who's 68. His modified AGI for the year is $85,000. Well, 75,000 being the threshold, that means he has an excess of $10,000. That's multiplied by 6%. That's a $600 reduction. So the senior deduction for this individual is not going to be $6,000. It will be $5,400. Still get something, but it is starting to phase out. There's also a caveat that taxpayers have to include a qualified Social Security number on the tax return. If by chance they transpose the wrong number when they're keying that into the computer, the IRS can basically treat that as a mathematical error. They'll make the adjustment, disallow the deduction. Taxpayer still has the ability to go back and amend and correct and put the valid Social Security number on there if they just made that honest typo. Here's a second example. Again, going through the math of the phase out, we've got a husband and wife. Robert's age 64, Julie's 66. They file a joint return. Combined AGI of $225,000. Now, the phase out starts at $150,000 for a married couple, so they exceed that threshold by $75,000. That's multiplied by the 6%, so that's a $4,500 reduction per eligible individual. So that means $1,500 is allowed for each eligible individual, and in this case, there's only one eligible individual. The husband was only 64. He's not old enough. She is 66 in this example. I think that's what the setup was. And that means they'll get a $1,500 deduction on the tax return. So here's how it looks on the Schedule 1A, modified AGI of 225. Obviously, they're above that threshold that entitles them to a deduction of $1,500. That total deduction then is carried over. This must be the only thing that they have on their tax return on Schedule 1A. That then carries to page 2 of the 1040. So it reduces taxable income, and that's the math and how that works out. Now, for additional information, you can always check out our website at backtobasicsbtb.tax. We have a registration there for a free monthly newsletter with additional updates as new law comes out or changes or clarification comes out from the IRS. We have textbooks available that for those people who missed an event but would like to get a textbook for one of the events that they perhaps missed. You can also check out our brochure to look at the seminars and webinars and the offerings for the upcoming year. Thank you.